The 2026 money framework used by the top 1% earners in the United States is not built on shortcuts, viral tricks, or high-risk speculation. It is built on systems that quietly compound over time. Most people never see these systems because they focus on income alone, while the top 1% focuses on control, structure, and long-term positioning. In 2026, the biggest difference between high earners and everyone else is not intelligence, it is how money decisions are sequenced. The first principle they follow is income design before income growth. Most people ask how to make more money. The top 1% asks where income should come from so that it remains stable during market stress. In the United States, this means prioritizing income sources tied to real demand, essential services, and long-term contracts instead of trends. In 2026, top earners deliberately reduce dependency on hourly or task-based income. They move towards structured income such as equity-based compensation, revenue-sharing models, long-term consulting retainers, digital infrastructure ownership, and cash-flowing businesses that serve recurring needs. They do not abandon earned income early, they convert it. For example, a professional earning a high salary does not rush into risky investing. They first transform their expertise into scalable assets such as licensing, internal tools, training systems, or service frameworks that companies repeatedly pay for. This creates income layers without relying on leverage or debt. The second principle is expense control at the system level, not lifestyle cuts. Most people try to save money by cutting coffee or subscriptions. The top 1% redesigns cost structures entirely. They optimize housing, transportation, taxes within legal limits, and operational costs so that expenses remain low relative to income growth. In 2026, housing decisions play a major role. High earners increasingly choose flexibility over ownership when ownership creates cash flow pressure. They analyze total cost of living rather than emotional value. The goal is liquidity and mobility, not status. Transportation follows the same logic. The top 1% treats vehicles as tools, not rewards. Capital is preserved for productive use rather than depreciating assets. This behavior compounds silently over years. The third principle is capital allocation discipline. This is where most people fail. They invest emotionally or reactively. The top 1% follows allocation rules that rarely change. In 2026, their capital allocation favors productive assets, operating businesses, private opportunities with real cash flow, and ownership stakes where value creation is visible. They avoid instruments where returns depend purely on price speculation or interest-based lending. They also maintain higher cash reserves than the average person. This is not fear, it is optionality. Cash allows them to act during downturns, negotiate better terms, and avoid forced selling. Another critical behavior is risk separation. The top 1% never risks survival capital. They divide money into operating capital, growth capital, and protection capital. Each category has rules. Growth capital can fluctuate. Protection capital cannot. This separation prevents emotional decisions during volatility. The fourth principle is time leverage instead of money leverage. Many people try to use borrowed money to grow faster. The top 1% uses time, systems, and people. In 2026, automation plays a major role. High earners invest early in tools that reduce decision fatigue and repetitive work. They build processes that run without constant attention. This allows focus on strategy rather than execution. They also delegate earlier than most people think is reasonable. Delegation is not about cost savings. It is about cognitive bandwidth. High-value decisions generate exponential results. Low-value tasks consume mental energy. The fifth principle is skill compounding. The top 1% never stops building high-leverage skills. These are skills that increase earning capacity across industries. In the United States, the most valuable skills in 2026 include advanced communication, negotiation, systems thinking, financial literacy, data interpretation, and leadership under uncertainty. These skills increase income without requiring additional hours. Most people separate learning from earning. The top 1% integrates them. They choose roles, businesses, and projects that pay them to learn. This creates upward momentum that others cannot replicate easily. Another behavior most people miss is network intentionality. The top 1% does not network randomly. They build small, high-trust circles aligned with long-term goals. In 2026, access matters more than information. Information is widely available. Access to decision-makers, deal flow, and private opportunities is not. High earners invest time in relationships that compound over decades. They also protect their environment aggressively. This includes physical space, digital input, and social exposure. Noise reduction is a strategic advantage. The sixth principle is downside protection first. Before pursuing growth, the top 1% asks what can go wrong and how to limit damage. They diversify income sources, maintain insurance where appropriate, and structure businesses to isolate risk. They also avoid lifestyle inflation that locks them into fixed expenses. Flexibility is treated as a form of wealth. In 2026, economic cycles move faster. Technology accelerates disruption. The top 1% prepares for volatility instead of reacting to it. This preparation allows calm decision-making when others panic. The seventh principle is ethical consistency. This is rarely discussed publicly. Long-term earners avoid activities that create legal, reputational, or moral risk. They understand that one bad decision can erase decades of progress. They choose clean income paths, transparent structures, and sustainable value creation. This reduces stress and increases longevity. Finally, the most important difference is patience. The top 1% plays long games. They do not expect immediate results. They accept delayed gratification as a strategy, not a sacrifice. In 2026, overnight success stories dominate attention. Quiet multi-year frameworks dominate outcomes. The top 1% understands that stability creates freedom, not volatility. This framework is not exciting. It is effective. Most people will ignore it because it requires discipline and clarity. Those who apply it consistently position themselves for durable wealth regardless of economic headlines. Part 2 will break down how these earners execute this framework step by step in real life, including how they structure income streams, protect capital, and scale without exposing themselves to unnecessary risk. In 2026, execution is where the gap widens between people who understand this framework and those who actually benefit from it. The top 1% does not wait for perfect conditions. They execute using controlled steps that reduce exposure while increasing upside over time. The first execution step is income layering. High earners rarely rely on a single source of income, even when that source is large. They intentionally build layered income where each stream serves a different function. One stream covers core living costs, another funds growth, a third provides optional upside. In practice, this often starts with earned income from a profession or business role. Instead of upgrading lifestyle, excess cash is redirected into building secondary income that does not require constant presence. This includes ownership stakes, long-term service agreements, or digital systems that solve recurring problems for US-based customers. In 2026, many top earners focus on business models tied to compliance, infrastructure, education, logistics, healthcare support services, and operational software. These areas grow steadily because demand is persistent, not trendy. Stability matters more than excitement. The second execution step is capital protection through structure. High earners separate personal finances from business operations cleanly. This is not just for legal reasons, it improves decision quality. They maintain clear cash buffers for both personal and business use. These buffers are sized based on volatility, not optimism. This allows them to continue operating without stress during slow periods or market disruptions. In 2026, the ability to survive without forced decisions is a competitive advantage. Many people fail not because their ideas are bad, but because timing pressure destroys patience. The third execution step is disciplined reinvestment. The top 1% does not reinvest everything automatically. They follow reinvestment rules tied to performance and cash flow health. Only surplus capital is reinvested. Core stability is never sacrificed for growth. This prevents the cycle of overextension that traps many entrepreneurs and professionals. They also favor reinvestment into existing strengths rather than chasing unfamiliar opportunities. Expanding what already works reduces risk and increases predictability. The fourth execution step is selective scaling. Scaling is not about speed, it is about control. High earners scale only after systems are proven under stress. In 2026, this means stress testing operations against higher costs, lower demand, and regulatory changes. If a model cannot survive these scenarios, it is redesigned before expansion. Hiring decisions follow the same logic. The top 1% hires slowly and removes misalignment quickly. Every additional person increases complexity. Simplicity is preserved wherever possible. The fifth execution step is decision filtration. High earners reduce the number of decisions they need to make daily. They use rules instead of constant analysis. For example, they define in advance which opportunities they will always reject. This saves time and prevents emotional decisions. They also define minimum thresholds for time, return, and risk before considering anything new. In 2026, attention is a scarce resource. The top 1% protects it aggressively. They limit exposure to noise, constant news cycles, and social comparison. The sixth execution step is strategic patience. Most people underestimate how long meaningful results take. High earners plan in multi-year cycles. They set expectations based on realistic timelines. They do not abandon strategies prematurely due to slow starts. They allow systems time to mature. In the United States, many durable businesses take 3 to 5 years before producing significant excess cash. The top 1% prepares financially and mentally for this reality. The seventh execution step is environment control. This includes physical environment, digital environment, and social environment. High earners design workspaces that reduce distraction. They curate digital input carefully. They avoid constant consumption of short-form content that fragments attention. They also limit time with people who reinforce scarcity thinking, fear-based decisions, or impulsive behavior. This is not arrogance, it is risk management. The eighth execution step is continuous skill upgrading. Skills are treated as assets that depreciate if not maintained. In 2026, rapid changes in technology, regulation, and consumer behavior require constant adaptation. High earners invest time weekly in learning that directly improves decision-making. They prioritize applied knowledge over theory. Learning is immediately tested in real scenarios. This creates feedback loops that accelerate competence. The ninth execution step is measured exposure to innovation. The top 1% does not ignore innovation, but they also do not chase it blindly. They observe new technologies and business models from a distance before committing capital. Early experimentation is done with limited downside. Full commitment happens only after validation. This approach allows participation in upside without risking core stability. The 10th execution step is long-term reputation building. Reputation is treated as a financial asset. High earners deliver consistently, honor agreements, and avoid shortcuts that damage trust. In private markets and high-level networks, reputation determines access. In 2026, trust reduces friction. Reduced friction increases speed and opportunity quality. The final execution step is periodic review and simplification. Complexity creeps in over time. The top 1% regularly reviews finances, operations, and commitments. They remove what no longer serves the framework. They simplify aggressively. This keeps systems resilient and adaptable. This entire execution model works because it aligns behavior with long-term outcomes. It does not rely on prediction. It relies on preparation. Most people will not follow this approach because it lacks excitement. It requires restraint, discipline, and delayed gratification. That is precisely why it works. The top 1% does not win by being smarter. They win by being consistent, structured, and patient in a system designed for durability. This framework is available to anyone willing to apply it honestly and persistently. The barrier is not access. The barrier is behavior. In 2026 and beyond, sustainable financial success in the United States will belong to those who build systems that protect downside, compound upside, and preserve freedom over time.